right, everybody. Welcome back to Market Mavericks. It's been a little while, but we are back here in the new year. Happy New Year to every one of you guys, and Happy New Year to Scott and Mike. How you guys doing?
Doing great.
Good. All right, where do we start, guys? I'm going to throw it to you guys. Where do you guys want to start today?
I throw it to Mike. He's always my go-to spark of inspiration.
I appreciate that. It's a lot to live up to. I can start with showing a few screens of things that I just published on that really made me think about what I was thinking about when I took a week off over the holidays. And the key question is gold poised to beat Bitcoin in 2024? Now, I think it's a bit of a controversial statement. I know most Bitcoiners don't like that. Let's just look at the facts of 2022. All risk assets went down. Bitcoin kind of led the way. 2023, all risk assets went up. Bitcoin kind of led the way. Now, it's got a good reason for that. But what I want to show you in this chart is the key thing I'm worried about is if you look at that Bitcoin to gold ratio, which I show you in white, it's really lagging the S&P 500. And a lot of times it makes intuitive sense. The Bitcoin gold ratio should be a leading indicator. And when it peaked in 2017, S&P 500 didn't bottom till 2020. Same thing, that ratio peaked in 2021. And S&P didn't bottom till 2022. It's something I'm really worried about looking into this year. And a key thing I want to point out, something I've always watched a lot when I trading from an options background, is option volatility. And the book I've been reading is The Price of Time. I forget the author's name. I can dig that up a little bit. It's all about the history of interest rates. It's kind of been my history since I've been in the business since the 80s. And volatility and what matters with volatility and interest rates. And what I show you here is just the volatility of the VIX in white. It's a 10-week moving average minus the T-bill rate. So volatility gives you a measure of where markets should move or price to move. If you take that T-bill rate out of it, minus it kind of T-bill rate is the basics for all foundations. So basically, anybody who doesn't make 5% this year is way underperforming T-bills. And you don't want to underperform T-bills. So that's why I show right now is volatility on the VIX minus the T-bill rate is the lowest on a 10-week basis since just before the great financial crisis. And the lesson I learned trading volatility in trading markets is volatility is always mean reverting. So it only is upside. And I overlay that with the Bitcoin gold ratio. I just look at that as, okay, if volatility is going to pick up in the stock market, it's probably going to start off with Bitcoin leading the way. So I just want to show you a few more charts in that, and then we can get into the bigger picture. This is just a bigger picture of the same chart of volatility on the VIX, factored minus the T-bill rate, and you can see how right now it's the lowest since right before the great financial crisis. And that was one of my best trading periods because I just was looking for volatility and mean revert. Obviously, I was early, which usually happens. But all that I show you is overweighted with gold versus the S&P 500. When volatility goes up, gold almost always outperforms. And volatility goes down, gold underperforms. Now we'll tip over to my space crude oil. I think crude oil is going to 50. And as a rebound, technical rebound from failing at 90 or holding resistance at 90. And the one good reason is what I show you in this chart in white. I started using this metric last year, and that is if you just take the excess of production in crude oil, liquid fuels in the US and Canada, and you add that to that OPEC spare capacity. OPEC's been having to add spare capacity, cut back on supply that they're putting on the market because of this excess supply in North America. You can see the downward trajectory for crude oil. So to me, that's where things are going. Simple little chart. If you put the S&P 500, copper, and US 10-year note yield all on the same scale, just take the S&P 500 divide by 1,000. S&P 500 looks a little expensive right here, and copper and the 10-year note are kind of hanging out just below 4% of $4. I want to show you a cool little thing, and I'll end on this, is one little thing I used to make a living at when I traded in the pits and traded with clients was trading gaps. And I know if you do that, and I see Garrett, you're nodding your hand. I know Scott, you do that, but when I was at a hedge fund, we traded the S&P 500 E-mini as the benchmark for risk assets on a global basis. I think it's more so now. It's just a global benchmark for risk. And we got a little gap down here to 60 and around 4,600. That's on the weekly S&P 500 E-mini. I think that's the first thing we should be looking to do is just fill that gap. And what we do from there, I'll let you guys guide me. With that, I can pass it back
Yeah,
to you.
so I'll just jump in real quick, and it's interesting. You say the 4,600 level, and that really, at least on the S&P chart, would just be a reversion to the previous pivot high that we hit in July, right? So one of the things I've been looking at on the S&P is just like, okay, well, the S&P had this banner year. We know that the Nasdaq 100 was up the greatest move since 1999. So you have to just, even if you're bullish net, you still have to say, okay, it's due for a pullback, and that 4,600 level has that confluence right here at that previous pivot high right here as well. So I think that makes a lot of sense. Now, are you looking for volatility to really start to spike in 2024? Like, do you see the VIX maybe getting above 30 at some point?
I don't know how high it goes, but on my chart, I just show it's a lesson I learned in the 80s trading in the options pits in the Chicago Board of Trade is volatility is always mean reverting. That's easy to say, but it always is. And it can stay low for a long period of time, and it can hammer you when you're long buying vol, buying gamma, and trying to make money just trading the gammas. And also it'll just rip people apart when it finally reverts higher. So I just like to point out the facts. Here it is now. Now this is volatility of the VIX. Now obviously I adjust a little bit. I'm taking the 1 year bill minus that. I think I can really dig into why that makes sense to me, but that may take up too much time. But to me, it makes a lot of sense. Is there's no room for volatility, very little room for volatility, but to go up, and very little room for yields, but to go down. So what does that mean for risk assets? Probably bad for, probably it's going to take the S&P 500 going down to trigger that. And maybe not. Maybe we can get through this with time. But typically, when volatility is this low, you don't want to be long the S&P 500 or risk assets. And that's just where it goes. Who knows? But so the bottom line is when it gets that low, there's a lot of room to go up.
So Scott, I got to ask, are you still long TLT?
Yeah. And I have no intention. I listen to Mike. Call me in 2025.
Nice.
Right? Yeah. I got long at the dead ass bottom. I'm not playing with it right now. I'm not playing games. We'll see what happens. Right.
Nice.
So it has the potential to be one of those sort of mega long trades. Everything Mike just showed me only confirmed my echo chamber bias that I'm in the right position here.
Yeah, well, think about
if you even
TLT.
Take a look at it. It's bouncing right. I mean, this right now, this move is a move back to the 200 MA on the daily, almost to the penny. If you have my chart there, you can see right there. I mean, 2 days retesting that. You got the 50 MA screaming up. We've got lots of volume. It got to oversold. So, overbought. So no surprise with some bearish divergence, actually. But yeah, I don't see any reason to exit an 84 TLT position when I'm sitting at 97, and there's no reason fundamentally for me to change.
So and this goes out to both of you. I have a question. So we saw the ADP private sector numbers remain strong today, right? So they were still above expectations. Jobless claims are still historically around 200,000, which is historically low. Do you guys expect that labor market to crack? I mean, like the weird thing is we get different data, right? There's certain data that's showing us that there is weakness, and then these headline numbers are showing us that there's really not. Where do we go? Like, do you say it's going to come? Are we eventually going to see that weakness?
Yeah,
or are we going to have a perfect landing?
Yeah, I think that's go to Mike on this in a second, but I think, putting the tinfoil hat on, it just seems like the headline numbers are cooked, right? Yeah. Every time I seem to look at the headline numbers and dig in even a little deeper, it's like someone's taking their 7th job at their 4th fast food chain, and we're counting that as, 7 new jobs, or it's 70,000 of the 200,000 or coincidentally government jobs, as was one of the reports recently. And so, I just don't put that much faith in any of the headline numbers provided by our government anymore. I don't think that that's like crazy tinfoil hat anymore. I don't really believe their CPI numbers, as we know that they recalculate the way that they do it relatively consistently. But I'll say something. I'm going to steal Mike's own words right before he gets to go. When you're at historically low, there's only one way to go.
Right.
And it's back the other way. And when that happens, as James Lavish often points out to me, it happens very, very fast. So when you start to see those unemployment numbers rise, it never happens slowly.
Yeah, well, I want to tilt over to just something that was featured as a top story on the Bloomberg terminal today. This is just our latest from our Bloomberg Economics, pointing out the non-farm payrolls are really flagging a recession. Now, she digs into the details, but what's really been growing is healthcare. Everything else is starting to lag, and the signs are all there. But I like to, now she's been early, and some people might say wrong, but these things just take time sometimes, and it's just the exercise of patience, which I'm not good at. But from a commodity standpoint, this is why I showed you that chart when you were speaking about TLT. I want to show you this from a commodity standpoint. There is nothing but signs of global recession. I mean, industrial metals are still declining. And energy still declining. A lot of people are scratching their heads. The bullish commodity people can't figure out why. And I think there's one main reason why. Number one, they got too high. But it's going down, and it's the global tilt towards recession. Now, it can't not say that. It cannot speak about deflation, which I think we're going to, without mentioning China. China is clearly in a deflating economy right now. Now, they show positive GDP, but PPI has been negative for a while. Their interest rates are declining. They're adding stimulus. Their exports are declining. And the latest data I've been looking at is you look at exports from South Korea, or South Korea exports to China are plunging. So there's no more demand there. U.S. imports from Mexico are more above China for the first time in 20 years and still rising, because it's just the complete getting out of China. I look at that as there's a Great Depression happening, getting started, a great reset getting started there. Now, it's the second largest economy. We look at the third largest economy. Japan and Germany are in there. They're both technically somewhat in recession. They have extremely low rates. I think it's just a matter of time for the U.S. to catch up to that. And that's from a commodity standpoint, it's a very clear global recessionary trajectory, and just a question of, will we get the S&P 500 to lift all boats this year? And I mean, yeah, I was wrong last year on that part of it. But key thing I would like to point out is, if we want to tilt a little bit over to Bitcoin and ETFs and stuff, is the number one trade for the ETF anticipation was GBTC. And most of that's over. I mean, GBTC started last year at a 50% discount. Now it's close to NAV. Maybe 6% now. That was the number one trade if you're playing for an ETF, and it's already happened. So what do you do now? Is how much left is in that trade? Now, there might be a long-term enduring demand in buying and people getting out of other assets and going to Bitcoin. But I look at that as we tilt towards recession, I still think gold is risking at greater risk of outperforming this year, partly because that global tilt towards deflation.
Quick question for you guys. So gold is kind of the no-brainer for a rough economy, for situations like that. What about silver? Silver, is it more of an industrial metal now, or is it still a store of safety? Is it both? Do you guys expect it to outperform? What do you guys think?
I'm happy to go there unless you want to first, Scott.
You please, Mike. That's your department.
I published on that a little while ago. I won't now, but silver is much more of it's becoming more of an industrial metal every day and less of a precious metal. And that started in the 16th century when Sir Isaac Newton was head of the mint in England. But it's also tilting that way completely. It's performing just like copper. I'm bearish copper because of the industrial aspects, and gold is completely different. I like to point out the fact that the central banks are accumulating gold at the greatest pace, almost the greatest pace in history. They're not buying silver. Silver's not really a monetary metal anymore. It's much more an industrial metal. So if we get this global reset, if we get a little decline in the S&P 500 and continued decline in the in equity markets in China, silver is going to suffer.
That's the Dave Weisberger theory, right, Mike? That silver was demonetized by gold, and that Bitcoin will eventually demonetize gold itself, right?
No.
Yeah, well, I can't disagree with. We like to, that'd be like that's happening. It's happening. Just look at the average 30-something. My kids, they don't care about gold, but it's going to be a while.
Yeah.
So speaking of Bitcoin, Scott, what are we expecting that ETF approval by Friday? I mean, that's what everyone's saying. We're hearing rumors one way, then the next day they flush it on a rumor this way.
Yeah, the last 2 hours, the rumor mill has gotten out of control. I can just tell you, I'm hearing it literally everywhere that the issuers, or the people who have filed, are starting to hear from the SEC as of today and tomorrow, even though it hasn't been publicly announced that they'll likely be able to launch next week. So this is happening, which is ironic because yesterday, apparently the market dumped because it wasn't going to happen based on no-name analysts from no-name company in no-name country that somehow went viral, but none of that is actually what happened, as we know. I mean, what happened yesterday, we had that move from over 45,000 to 40,600, a really significant move, over 10%. In a matter of what seemed like moments. This is the funding rates now. They're completely flat. But if you took a look at the perpetual funding rates yesterday, historically high was about 0.08. We had the highest amount of longs in years. They were paying the most to be long, 66% annualized for the right to be long. So if you were just short and that lasted a year, you'd make 66% of your money just by holding a short position. and open interest was massively high. So a very small move in the spot market to the downside, which somebody intentionally does, causes this major liquidation cascade. It's like Beauty and the Beast, man. Tale as old as time, right? I mean, we know exactly what happens every single time we get high on either side. You get a long squeeze or a short squeeze. And we saw long squeeze. We're already bounced back to 44,000. Everything's reset. I'd make the argument this is an extremely bullish retrace, right? I mean, it's a healthy correction, stayed above 40,000. We were overbought, over leveraged, over everything. And now none of that is there if we get this approval. I would say that in those conditions, we would have gotten much more volatility and a bigger whipsaw likely with the approval trade, whatever that trade ends up being, because there's less room to go. You would have seen that squeeze come on that up move. So if we get an up move now, really those longs aren't there to squeeze anymore.
So just I'll throw up my chart. So just interesting little tidbit is that when you saw that flush yesterday, look at these perfect parallel lines. How again, parallel with parallel, we hit the high end here, we have a high pivot over here, and then look at where the low yesterday was, right exactly in line with that. And we've just stayed in this channel now since early December, and it's just kind of chopping sideways. And I think that's exactly what it is, wipe out the bulls one way, wipe out the bears the other way, and just wait for this approval. But the bigger question is there's two competing narratives, right? There's the narrative that you're going to see a pop on approval, but then there's going to be a sell the news event. And then there's the other narrative, which is the institutions are going to be buying tremendously on this. So price is going to shoot to 50, then 100,000. Which one is the right one, Scott?
I think both, and it's just a matter of time frame. So I think that institutions will massively buy, RAs will massively sell this to their clients, but I think that's going to take 6 months to a year to start to compile. It kind of reminds me, I keep saying, of the halving trade, right? Everybody gets really excited about the Bitcoin halving, but nothing really happens when the halving happens. It takes 6 to 9 months. That's why you always see a boring summer, and then the fall things start to ramp up. That's when the actual supply decrease starts to matter. I mean, I do think that we're going to see more immediate AUM than people are expecting. I'm hearing some pretty low numbers. I mean, BITO, when it launched, the Bitcoin Futures ETF was the most successful ETF launch in history, $1 billion in 48 hours. We're going to have 14 of these already running massive marketing campaigns for Bitcoin launching, and price is pretty good. It's not like we're in a bear market anymore, right? And so I have a pretty high expectation. I think it's going to be like the GLD, right? You got this big pop for a little while, and then a really slow kind of bleed out for a while, and then you enter the halving cycle exponential uptrend that happens for quite a while. I mean, look at that move yesterday. Just since you have my chart up, this was the first time that we tapped the 50 MA on the daily since last October when price was 26,000. So if you were looking for just even a basic mean reversion trade, that's exactly where you bounce, exactly where you pop. So I don't see anything particularly bearish here. And my expectation is it's a massively bullish event over time, but that if the leverage builds up quickly on a big move up, there's going to be a lot of people who have been anticipating this trade. They're going to take profit.
So I got to follow up on that.
Gotcha.
And I have a chart on, if we're going to mention BITO and launches of ETFs, the history is not good. I mean, I just remember it started for me on December 2017, 2 Sundays in a row. I remember on Sunday evening, I was asked to comment on Bloomberg Radio about the launch of Bitcoin futures ETFs. Yeah, no, that put in the peak. It also peaked the volatility because it brought Bitcoin into the forefront of arbitrage. And that's what I think was the key arbitrage trade for Bitcoin last year was GBTC, just taking that discount out. Now that trade's mostly over, but you just look at the chart of BITO, it's down 50% from when it was launched. And we have done such a great job of buying the rumor. Now we have to have a broad amount of ETFs approved next week, or there's a big problem. And then we have to have what we've been hearing since always been in the business, since institutions are coming. And you only really hear that when markets go up. You don't hear it when it goes down. That's why I'm just, having been a bit of a veteran of markets and sentiment and human nature, and I wouldn't say I'm a veteran of Bitcoin, but just watching the flows. That's why I point back to this chart. If Bitcoin's so great, why is it doing so poorly versus gold and doing a similar pattern as it in the past and underperforming with the stock market breaking out? And then remember, the key thing we're going to be expecting, institutional money coming into space is going to happen. It's a matter of time, but also they probably are on a risk-adjusted basis doing much better in the NASDAQ than Bitcoin has performed for the last 4 or 5 years. And that's why I'm concerned that I think people are overhyping this. From people who are in the space who have vested interests are way overhyping the institutions are coming. How many times have we heard that quote in the last 5 years?
Yeah. No, I agree with you. I think it's one of those things where I don't know anyone that's in the Bitcoin crypto markets that's not long going into this. I think you got to flush out of leverage, but overall, I agree with you. I think it's one of those things that over time we all agree. There's more money coming to Bitcoin over time. It's going to go further up. It's just a matter of does it see 30? And that's a question I'll pose to you guys. Do you think you see 60 first, or do you see 30 first?
Neither. I don't think we're going to see 30. So I think that's the answer. But if we're talking about if we're going to, let me rephrase that. I don't think we see both, because I don't think we see 30. But I could be wrong. I'd be very surprised. I think there's just a lot would have to happen. I think we only see 30 if the global economy goes to shit, the stock market absolutely crashes, right? And in which case I absolutely see that. But all things considered equal, knowing what we know right now, I'd be surprised to see 30. I would not be surprised to eventually see 60. And I think within this year, 60 is almost programmed in with the halving cycle, if it does repeat, which you can't take for granted that it will. I just think it's much more likely at this point than 30 is. I'm going to eat these words. I have a feeling.
No, I think that's a good response. Scott, the key thing I like to ask myself is, if it goes straight to 60, will this be the easiest, most broadcast trade I've ever seen? And I'm just used to have hair. I just have never seen a decent high volatility asset in a bull market that's easy. You got to have those pullbacks to make it difficult. And this straight up, at this time last year, around 15 at the end of last year, it was obviously too cheap. We all pointed it out. Yeah. But now, with everybody's bullish and it's up so much, it's just one of those simple rules. I just look at it as a rational risk asset manager. If you were astute enough to be overweight Bitcoin a year ago, are you overweight in your portfolio of Bitcoin now? And if you are, your risk is exponential what it was a year ago, because it's already gone up that much. Just a little pullback is what we typically takes to flush out these leverage. I
have to ask Mike again, because I'm looking at your chart, and just for me, it's very small. I was under the impression by looking at the numbers that Bitcoin has wildly outperformed gold.
So it has from the bottom, but not from the peak. And that's what I show you. The ratio's basically 22 ounces of gold for one Bitcoin. The high right here was actually a little bit higher. This is a monthly chart, was 37. So it's down a decent chunk, at least a third from that Bitcoin. That's just like I point out, and I can show this versus NASDAQ. I can show you Bitcoin versus NASDAQ. It's still underperforming, and particularly on a risk-adjusted basis. And a lot of that started in 2017 with the advent of futures. And that's what futures do. It arbs everything else. So that's one thing we should expect in Bitcoin. Don't expect anywhere near the type of appreciation we had in the past, and the volatility should continue to decline. But this is the key thing I like to point out now, is if you're sitting at a value at risk model, which I did at hedge funds, and you look at all your choices and in your portfolio, and you were, say at the end of last year, you were long a volatility weighted amount of Bitcoin and NASDAQ, you did well, but the NASDAQ portion has actually performed a little bit better. And now you're overweight those assets. For a typical portfolio if you haven't readjusted. So I look at it as from a value at risk model standpoint, Bitcoin has not been doing very well versus the NASDAQ. Is that going to change with ETFs? Maybe. But what are the ETFs? Where's that money going to come from? Mostly from people who have been exposed to the NASDAQ the last 20 years.
Yeah, when I look at this, to me, it means it's a matter of time frame. I'm not saying that you're wrong, but to me, all I see is a huge line going from the left to the right and up and to the right, meaning Bitcoin's outperformed. If we choose, obviously, the deadest high of Bitcoin, then yes, it's underperformed since then. So I think it's just a matter of which point you're trying to make. I do agree, but I think that also, if you're charting that, looks like it's about to break out to the upside and crush it.
That's the key thing. It's the S&P I show you right here. It's harder to see. It's the S&P is inched higher. So to me, and all I see here is Bitcoin is following risk assets higher rather than before. Here it was leading. And the risk asset, number one measure of risk asset on the planet is S&P 500. So my point is, okay, we get a little bit of pullback in the S&P 500 just to fill that gap around 4,600. That's nothing. If we just get a little bit pullback on this chart, this is a quarterly chart. It looks like nothing, but it's going to mean a lot for markets, particularly for those who think stock market never goes down.
Does Scott, you may know this, but does every single ETF that's in proposed approval, do they always have to back every dollar with Bitcoin? Like, so for instance, 1-to-1?
Yeah, my understanding is that even with the cash create, the way that it's being structured, they still have to hold the Bitcoin for what's being issued.
Okay.
Mike can correct me if I'm wrong, but I've asked both Balchunas and James Safer that very question, and they
So
said yes,
so
and,
if a
and
billion
basically
dollars
everyone does.
if people invest $1 billion into the ETF, they have to buy $1 billion in
Yep.
Bitcoin.
Yep.
Okay.
In theory, but there's also a big question as to what GBTC's role will be in that. And if Grayscale converts their 25 whatever billion dollars worth of Bitcoin, if some of that could flow out and into the other ETFs, then it's more of a horizontal move, obviously, than a new purchase to some degree. So there's a lot of
Gotcha.
ways that this can kind of happen. But yeah, I would say generally, if we see demand, Bitcoin's going to go up. And then you think about the halving, cutting the new supply,
So
in half in April if we're getting that demand. Listen, we can be totally wrong, but I like to take the statistical odds, and I would say that there's more tailwinds than headwinds right now, specifically for Bitcoin. And so I would rather be long than short.
So well, being short Bitcoin is for the astute traders. Not one of those. But I'm glad you brought that up. So let's point out what really is going to happen when you get an official, safe way to invest in Bitcoin through an ETF, considered one of the safest investment vehicles there is. Why would you be, for those who've been getting Bitcoin exposure the last 5-10 years, or last 5 years through things like GBTC and MicroStrategy and any other vehicle there is, of course, the actual Bitcoin is one of the best. Why would they not migrate towards that ETF? So that's the key thing people are forgetting, I think, is GBTC has to convert to an ETF, or it's just going to die. I mean, it's not going to, unless it's going to have too much competition. And then you look at things like MicroStrategy and so many other proxies, just like equities that people are using, being exposed to Bitcoin. There's going to be most people said, okay, I just wanted that beta to Bitcoin. They're going to say, and I've been using these instruments because I had no other choice, are going to go to the ETF and say thank you, but they're going to be selling some of these other less perfect one-to-one correlated assets.
I think it's bad for the sort of Bitcoin adjacent assets, the Kathy Wood sell-off portfolio. But I don't think it will massively affect spot Bitcoin, because I think the people who bought spot Bitcoin are comfortable with it and did it for a reason, right? And I think there's going to maybe be a generation gap for who actually views the ETF as the safe way to own Bitcoin, because Bitcoiners don't, right? And so I think it's going to be the new entrants largely that want exposure via an ETF. And so I do think that this could affect MicroStrategy, even Coinbase, certainly some miners to some degree, to a minor degree. But I think net it's going to be a massive positive over time.
So in the final couple minutes here that we have, I just want to flip over to the Federal Reserve.
Dollar.
To what the dollar's doing and what yields are doing. The 10 years up a little bit today, just kind of knocking on 4%. So right now the Fed continues to kind of impress upon us 3 rate cuts this year now. But the markets keep pricing in 7 or 6. What is it? Mike, you probably know exactly what it is. But the question I would have is, who's right? Or is it in the middle ground?
Yeah, I just pulled up my WIRP function. So the next main meeting is in March, and the market's about 70% that they're going to cut. But right now, the market's priced for about 150 basis points of cuts this year, which means 625 cuts, and there's only 8 meetings. So it means they're going to be cutting at every meeting, which typically that only happens if you have a pretty solid decline in risk assets. It's just very rare for that to happen. And particularly with inflation still very sticky, and with election year coming, there's so many reasons. So basically, the Fed is basically saying they might cut 3. The market's priced for 6. That's where the major dichotomy is. That might have a little issue with TLT in the short term, but I think the way this is going to be resolved is the only way I really see us getting those cuts is if risk assets go down and tell the Fed to cut, like industrial metals have gone down, like crude oil have gone down. But the stock market is the key one. Otherwise, why take the risk of making the mistake that they claim Arthur Burns made, and that Volcker fixed, with cutting too early and letting inflation get out of hand? That is going to be something that's going to resonate for the rest of our lifetimes. That was not an issue before, because the last 20 years they've been able to cut rates without inflation. That's changed.
Interesting. All right, man. Scott, anything in addition? I think Mike kind of summed it up pretty well there.
I think you got it.
All right. So on that note, guys, let's end it for today. As always, it's awesome to have you guys back. It's great to have Market Mavericks back on the air. We should be here next Thursday, I believe. Gentlemen, thank you, and make sure everyone watching follow these guys. They're the best, and learn from the best to become the best. That's what I always say. So have a great one, everyone, and thank you guys for tuning in.